In today's episode, I'll discuss the property clock for each city in Australia. So for those that don't know what the property clock is, look, it's basically a clock to determine where each market is at its stage of the cycle. So a lot of big companies use it to determine and say something's hot, something's cold, something's at its downturn, something's at its upturn. But the reason I do this is because I think they all get it wrong, because a property cycle is generally 7 to 10 years. For those that argue there's an 18.6 year cycle, I'd argue there's two cycles, whole property cycles within that for strict reason. But anyway, a property cycle is 7 to 10 years in general, and these organizations literally will change it from, downturn to hot within a monthly basis. And the truth is, it takes like minimum a significant amount of time, usually a few years, to move from one stage to another, depending on which part of the cycle it's in. So that's the reason I want to do this episode. And it's one that I think everyone will visually find it very appealing. So first of all, I'm going to give some definitions. Second of all, the stages of the property clock. Third of all, the cities in analysis. And then finally, the clock for each city and an overview of the property clock. Let's get into it. Look, let's just start with what it really is. As I said, it's the use of the general just clock that everyone has. And then what we do then is we use each basically number or numeric value to identify where each property market's at, so which stage of the market cycle it's at. So that's what the property clock is. Look, there's a few different stages of the property clock. So there's a few I just want to mention here, the main ones, and then a key part of one. So first of all, we have downturn. Second of all, stabilization. Third of all, upturn. Finally, then the boom section. And in the boom section, there's actually another section called the winner's curse. So the downturn of the market is categorized by a couple of things. So first of all, the market is overpriced. Second of all, it is often performed over its long-term averages. Third of all, consumer sentiment drops. Also, demand to supply ratio decreases and days on market increase. Because of that, prices start to decrease. And then finally, this will often last somewhere between 1 and 2 years generally. So the stabilization phase is when prices become sort of more affordable to the buying market. Demand to supply levels generally level out with consumer sentiment, as do days on market averages also level out. But the interesting thing about this stabilization phase is prices generally, as I said, stabilize, but this can actually last for a long time period, and it depends on the market you're in. So for example, Perth is known for having a very long stabilization phase, whereas Melbourne and Sydney have a much shorter one, but a much less intense growth phase generally. So that's something to just know about the stabilization phase of the market. Upturn is categorized by a few things. Prices become more affordable for most of the market. Consumer sentiment then tends to increase, as it previously has been below its long-term average in terms of over a couple of years. Demand to supply then starts increasing. Days on markets then tend to fall. Prices then generally will start to increase, and this will last for generally 2 to 4 years time, depending on the market again. Obviously, in Melbourne and Sydney markets generally last for a couple of years, this sort of phase. Finally, you've got the boom phase. So the boom phase is when the market becomes affordable and accessible for most of the market. Consumer sentiment is extremely strong, as demand to supply is as well. Days on market fall drastically, and prices substantially increase. This generally will last for 1 to 2 years in general. And the final stage then of the boom phase is called the winner's curse. And it's a stock market phase, but the winner's curse really is the final part of the boom phase. And it's characterized by consumers being euphoric and feeling as though things can never go down. What happens then is everyone FOMOs into the markets. They have a fear of missing out, regardless of their financial situation. Finally, days on market are then at their lowest and demand to supply is at its highest. Price guides are slashed and the market is in overdrive. Smashed and prices are in overdrive. And what I mean by that is, like, you can have a property that is on, like, let's say the suburb median, or it's probably worth $1 million. The agent lists it at 1.2. It still sells for 1.4. That's what will happen in the winner's curse phase of the market. And this is generally short. It usually will only last for about 6 to 12 months in nature. And what will happen there is things become very highly priced. So you get like suburbs like absolutely creaming their records. You get people that pay prices that should be 5 years in the future in the year that they're buying in. So that's what actually happens in the winner's curse phase of the cycle. Let's get into the property clock. So just to determine for everyone, each, should I say, stage of the cycle. So 12 to 3 is basically the downturn phase of the market. The stabilization phase is 3 to 6. 6 to 9 is the upturn phase. 9 to 12 is the boom, and the exact section of the winner's curse is the 11 to 12 phase of the market. So let's get into some of the cities I'm going to go into now. So let's first of all start with the primary cities. So they will be, and these are the markets I like investing in. So sorry to other people that don't like to see this, but these are the best markets to buy in. Sydney, Melbourne, Brisbane, Perth, Newcastle, Geelong, the Central Coast, and Wollongong. Those are definitely your primary markets to buy in. Let's get into the secondary cities. So Gold Coast, Sunshine Coast, Adelaide, and Hobart. Not saying these markets are rubbish, but they're definitely not as good as the markets I've previously mentioned. Let's start with Sydney. So Sydney is an interesting market because we've had a great growth phase over recent years, and we've had a little bit of a downturn in the past, and prices are generally starting to stabilize. So if I show you this, just in the Sydney market alone, this is where we are at in Sydney. And for a few of these markets, I'm going to break it up into different regions because I think it's very important. So you'll see basically the Shire, Inner South, St. George markets all being a little bit earlier in the stabilisation phase, whereas the Inner West, North Shore, and particularly eastern suburbs are further in towards the stabilisation phase. And the reason for this is because the markets that generally lead the Sydney charge are your literally premier markets. They lead the charge, and then the spillover effect happens to other markets. And the best markets to buy in are the eastern suburbs, North Shore, and Inner West. So they will lead the charge, and that's the reason the Sydney market looks like this. So just consider that it's in its stabilisation phase. You're not going to get prices to look in some markets. You might get them decrease slightly, but it's probably going to be flat for a little while. Look, they might increase a little bit, but we're not genuinely in an upturn phase yet, and probably won't be for a little while, probably a couple of years yet. Look, Melbourne is probably a little bit different. Melbourne has been in the stabilisation phase due to some very poor governance as well over the long term. Not long term, but it's probably the last 7 or 8 years. I'd say that's fairly getting towards long term. But it hasn't really done much over about since kind of that 2017 boom. So we had a bit of a decrease in, in 2018, 2019. Then we had kind of a dead cat bounce due to ridiculous lending in 2021. Then we had a bit of a decrease again kind of in 2023. But I'd call that kind of just stabilisation phase. It's not really a long-term growth phase or anything like that. 2021, a dead cat bounce is just basically when something out of the ordinary happens and the market lifts. So, if you look at, I'd say 2019 prices to 2022 prices, they are up a little bit, but not much, because it obviously bounced up, and then back to 2023, it went back down. But this is really where the Melbourne market's at. So you'll see the Inner North and Bayside are kind of they're well into the stabilisation phase, but not far as in as you sort of Inner West, eastern suburbs, and Inner City. The Inner East, some parts of the Inner East, I'd argue went further into that. So probably like your more Camberwell, Deep Dean to Box Hill, that area is definitely Hawthorns too. But I mean, if you take, your outer east, like especially past Blackburn, Mitcham, and outer parts of your Bayside too. So it's sort of your towards Mentone probably area. Wouldn't be as far along as somewhere like Elwood or Brighton. But that's the general market of where we are. Again, your inner city eastern suburbs, your inner west, and your inner east do really lead the charge, as do your premier Bayside suburbs as well. But Melbourne is really it is primed for growth very soon. Whether that be 1 or 2 years away, I don't know, but it is definitely primed for growth soon. Look, Brisbane is definitely into its boom phase, definitely. We had a ridiculous amount of growth in 2021 in Brisbane, a bit of a silent phase there. But look, Brisbane, we still do have a fair bit of growth left, and it's not simply because of the Olympics, it's because of the demographics and the undersupply in the market. And people from Brisbane won't like that I only do this, but I only look at kind of 10Ks either side of the CBD, draw a ring around it. That's where I look because all the best suburbs are there. But this is where we're kind of at. So you'll notice the inner south and inner west are a bit further into the boom phase than sort of other parts of the market. So your inner city, inner east and inner north, which are historically your best performing areas, are still earlier in their boom phase than others. And it's simply because their growth over the long term does better and they have a lot stronger long-term fundamentals behind them. So your places that are sort of around your sort of inner north, your Grange to kind of like Clayfield, your inner east of kind of like Norman Park, Bulimba to Camp Hill, that area does very well. Your inner city markets, I particularly am meaning like your Hurston kind of markets around there, probably to West End, that kind of inner city area is quite good as well. That's the areas I'm kind of talking about. So that's where we are with Brisbane. Look, Perth is further along than Brisbane, and despite a lot of people knowing that obviously Brisbane started growing before Perth generally has a shorter cycle. And not only that too, but it does a lot stronger in the cycle. So Perth's known for doing nothing for a long period of a cycle and then going absolutely ballistic. So I know we've got like 25 to 30% growth in a year this year, which is just insane. But anyway, this is where the markets are at. So Rockingham and Mandurah are a lot further. So they're getting into almost, I'd say, the winner's curse phase of the cycle because they are very expensive for how well they've done over the long term. They've like doubled in, like 3 or 4 years. Fremantle and the inner south are closer to that. So they're getting up towards that sort of winner's curse phase. But your two markets that I think are still got a fair bit to go and they will close out the Perth boom cycle better is your Joondalup, inner east and city beaches region. So that's kind of like drawing a line sort of up towards Joondalup, following the coast and going to kind of Mossman Park and taking that sort of triangle between those areas together. Those areas have the best demographics in Perth and are historically the tightest held in Perth. And they're close to all the jobs of the CBD, Osborne Park and Joondalup. So that area long term will do much better. Look, the thing I want to show everyone now is just the primary cities where they're all at. So here's where they're all at. So you'll distinctively see, I've just included Geelong, Newcastle, Central Coast and Wollongong here. You'll notice that Wollongong is a lot earlier into its stabilisation phase than Sydney. Then the Central Coast and Newcastle are a little bit further along, and Geelong is even further along than that. Mind you, I've showed you obviously the whole, should I say, the markets that I buy in these sorts of cities, but this is the general market I'm pointing out at the points that they're at. So look, Wollongong has done very well in the past, but because it doesn't have as strong fundamentals as Newcastle and the Central Coast, generally it is a little bit slower to pick up. That's the reason it's there. But, and so is Geelong. So Geelong sits behind Melbourne because of that. So that's where they're at. But you can clearly see that sort of our southeastern markets in Australia compared to Brisbane and Perth are much further into their they've already passed their growth phase, passed their downturn, and they're stabilising. But in my opinion, this is the time to buy here because you get much better deals and less competition. Brisbane and Perth, Perth especially is so hard to buy something good, and you're buying well into a growth phase anyway. So I wouldn't recommend buying there, to give you an idea. But Brisbane, you still have some good opportunities, particularly in the inner north and inner east. You've still got quite a bit of growth left there. They will close out the cycle very well. But again, it is into its boom cycle already, definitely. So just consider that. I'm just going to then go into, so for my more sort of interstate residents that don't happen to live in these cities and are looking elsewhere, I'll add just in the sunny coast, Gold Coast, Adelaide, and Hobart into here, just for your information. So Hobart here, you can see, look, Hobart had probably the best growth of anywhere for the last probably 12 years or so. So look, it is still decreasing a little bit. It hasn't got much left. It's still in its downturn. But look, I'd imagine it might last for another year at absolute maximum, maybe a little bit longer, but I think probably less. That's where it's kind of at. If we look at the Gold Coast and Sunny Coast. Gold Coast is a little bit more in it. Sunny Coast is further on the Gold Coast, again, due to the demographics not being as strong. And Adelaide, in my opinion, is it's already in its winner's curse phase. Like, those prices are too expensive for Adelaide, like way too expensive. Like, Melbourne's supposed to be like 1.8 times the price of Adelaide, and Adelaide's more expensive than it at the moment, to give you an idea. So that ratio is just way too expensive. And, you know, even the locals can't afford Adelaide at the moment too, which is where Hobart was about a year and a half ago. So it's getting towards that kind of stage. So I would not be touching it one bit. It's way too expensive, to give you an idea. So anyway, that's the property clock for everyone, and I hope you've enjoyed it. And I'll be getting stuff up like this on my site and probably updating it quarterly, so just hang out for that. But the big thing, again, I want to tell everyone is I've got a thing called Premier Properties that's coming. And so just check out my site for that, www.compoundinvest.com.au. But basically what Premier Properties is it's properties with above 13% total return. So that's 30-year capital growth plus immediate rental yield. So that's gross rental yield. And I'm telling you right now, most buyers agents will struggle to get anywhere from, most of them get 9.5 to 11% total return. And what they'll do is, a lot of the time they'll say, I've done 20% in a year, and they've bought in Logan, they've bought in, you know, regional Queensland. And yes, it might have done that over 1 or 2 years. Don't get me wrong, I get it. But for the next 20 years, it's going to do absolutely nothing. And then what further is going to happen then on top of that is, after that, you know, it's just going to do it 3 to 5% long-term growth averages. They might get 5 to 6% yield. So it's a total return of, like, let's say 10-ish%. And that's just crap. It's not going to change your life at all. So that's what Premier Properties is for everyone of you. Just view it on my website, and just, you'll find it. And if you're looking, sign up for it. I'm telling you, you'll have very good access to properties off market, pre-market. Some are on market. Some are even vendors actually just saying, hey, I want to sell, don't want to be rummaged through when I meet them at an open home, and that will happen. But look, for those people serious, and not even those people serious, but it's also people that might know a family member, a friend, a cousin, or someone that they meet that just is struggling. It'd be really good to just tell them about it too, because I'm telling you right now, people struggle, and this is going to give you unparalleled access to the market that no one else has. So look, sign up for that, and please subscribe to the channel, and let me know if you want any videos in the future. I'll do them to the best of my ability within my values and morals and ethics of what I do. No problem at all doing that. But again, thanks everyone for watching, and have a great day ahead. Cheers.